Welcome to video number 10, our T account exercise. We've learned about the basics of T accounts. So now we're going to move into our exercise where we take the journal entries we talked about and we're going to post those to T accounts. So remember, these are our journal entries. Our 12 transactions occurred during the year and we recorded journal entries for those transactions. Now all we're going to do is track and summarize these journal entries into the respective T accounts. So let's take a look here. Now on my screen, I'm showing you the T accounts for all of my accounts: assets, liabilities, equity, and income statement. And I've drawn T accounts for each one. We're starting from scratch. We're now at the beginning of the year, so there's zeros in all these accounts. But I want you to pay attention, where is the zero in each account? It's on the normal side of the T account. So for asset accounts, the zero is on the debit side, which is the left side of the account. For liabilities, the zero is on the right side, which is the credit side, which is the normal side for liabilities. And the same with equity. The zero is on the right side, which is the credit side. For income statement, it's a mixed bag. We increase revenue with a credit, so that's the normal side, which is the right side. So that zero is on the right side of the revenue account. And it's on the left side of the expense accounts, since we increase expenses with a debit. Now I'm just putting the zeros in this configuration just to remind myself the normal side of each account. And that tells you, if you want to increase that account, that's how you do it, is by posting an entry to the normal side of the account. So what's going to follow is our 12 journal entry transactions and posting those transactions into the T accounts. And you'll see that this is a pretty simple exercise once you get used to it. So our first transaction was a debit to the cash account and a credit to the equity account. Let me post this transaction. Now watch the cash account and the contributed capital account. And there the journal entry was posted. So you can see the debit to the cash account was posted to the debit side, and the credit to the contributed capital account was posted to the credit side of the equity account. And you can see I did this in Excel, so I'm having the ending balances of each account update live. So you can see the cash now has $2,000 in it, and contributed capital has an ending balance of $2,000, which is that bold number at the bottom of the T account. This is going to be pretty simple. We'll just go through our 12 transactions. Transaction number 2 is a debit to cash and a credit to debt. So watch the cash and the debt accounts, and I'm just posting that amount into the T accounts. Cash increases by another $1,000, and now debt increases by $1,000. Remember, we increased liabilities with a credit. So now that debt account is holding a $1,000 balance. Journal entry number 3, we're going to obtain some PP&E and lose some cash. So watch the cash account. Now we're going to have a credit posted into the cash account and a debit posted into the PP&E account. So there you go. Cash is now going down by $500 and PP&E has gone up by $500. Journal entry number 4 is inventory debited and accounts payable credited. So inventory will go up and accounts payable will also go up. Okay, so watch the inventory and accounts payable accounts. And there you go. Inventory went up by 200 and accounts payable went up by 200. Next transaction, we're going to now pay off that accounts payable. So now I want you to pay special attention. So what's going to happen is we're going to credit the cash account, and that's going to remove the cash from the account. We're also going to debit accounts payable. Now notice the accounts payable balance is holding a $200 credit. So when we debit the account by $200, that's going to zero out the account. So here we go. So now that I've posted that $200 debit to accounts payable, it's zeroed out accounts payable, meaning I don't owe anybody money now that I've made this payment. And then you can see the $200 credit reducing the cash account. Number 6, this is our revenue transaction. So let me just post this one all together. You can see the credit to revenue of $300, the debit to cost of goods sold of $100. You can also see the debit to accounts receivable of $300 and the credit to inventory of $100. Now notice I haven't done anything to retained earnings account. I'm not going to do that until the end of the period when I need to report a balance sheet. I don't need to report a balance sheet yet, so I don't need to update my retained earnings account every time I record a transaction to the income statement, just once at the end of the period. Okay, that was transaction 6. How about number 7? We're going to receive that cash from our customer. So we're going to zero out accounts receivable with a credit, and we're going to increase our cash with a debit. So there you see that posted to the account. Transaction number 8, we're receiving cash as a prepayment. So we're going to record deferred revenue. So cash is going up by 300, and that liability balance deferred revenue is also going up by 300 credit. Okay, transaction number 9, we're going to earn the deferred revenue. So we'll debit deferred revenue to zero it out, and then we'll transfer that balance into revenue. You can even think of it as transferring the credit from deferred revenue to revenue. And then also we're going to transfer that debit of inventory to be a debit in cost of goods sold. So here we go. We've got another $300 of revenue and another $100 of cost of goods sold. We also have zeroed out our deferred revenue, and now we've got zeroed out our inventory as well. We've sold the last of our inventory. Number 10 is a prepayment to our employee, so they're getting advance on their wage. We're going to remove that from our cash balance, and we're going to set up a prepaid asset there, a prepaid expense. So we've got less cash, but now we have an asset because we get our employee to work for us in the future. We've prepaid for that. Transaction 11 is they've earned it. You can also think of this as an adjusting journal entry, as I mentioned, or a general journal entry. It's not a very consequential distinction there. So we'll debit wages expense to increase wages expense by 100, and we'll credit prepaid expense because we no longer have that asset. Once the employee works for us, we no longer have prepaid work for the employee's future. So we're going to zero out that prepaid expense, and we're going to have incurred that as a wages expense because the employees earned it. Our final transaction is our PP&E has lost $100 of value. So we'll reduce our PP&E asset with a credit, and we'll increase depreciation expense with a debit. And that's it. That's the 12 journal entries converted into we've posted those journal entries into our T accounts. And now we're at the end of the year, and we've got all of the journal entries reflected in our T accounts, except for the closing entry, which we'll talk about in a future video. So that was it for the exercise on the T accounts. And in the final section of our accounting crash course, we'll talk about how we prepare financial statements, and then we'll go back to our exercise and we'll prepare the income statement and balance sheet for our company.